Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Apple closes a retail store in China for the first time ever. What this means for the iPhone maker's plan to revive sales.
Plus, US and Chinese officials continue talks to extend the tariff truce beyond a mid-August expiry, with tech export controls under the microscope.
And we discuss SoFi's second quarter earnings with the CEO, Anthony Noto, as the stock surges.
But it's alone in terms of surging right now, Ed. It feels as though the general markets are just treading water ahead of all-important Fed decisions tomorrow, a spate of earnings that is $11 trillion worth in market capitalization come Wednesday, Thursday. I'm looking at just the Nasdaq 100 clinging to gains of about 0.1% right now. We've got some big movers to the upside and the downside. Just get to some of the micro data.
Yeah, earnings is clearly a feature, right? So Spotify is where I'm starting. Surprise swing to a loss in the second quarter, largely because of Stockholm. And the trajectory of the stock in the quarter impacting that. We'll go deep on that later in the program. PayPal has made a late move in the session, and one of the factors behind it is the CEO on the call talking about worrying consumer data. We'll dive into that. Then Apple's kind of softer, down 0.7%, a big points drag at the index level, closing a store in China, which we can get to, and then headlines in the last hour from the Wall Street Journal that JP Morgan is now the front runner to take over that Apple credit card business. There's a lot to discuss.
There is, and there's a person to do it with. Bloomberg's Tom Giles joins us now. And Tom, just first of all, this signal that we're getting, pulling back from one particular area, bricks and mortar in China, is it a big deal for Apple?
China is a huge deal for Apple. Let's put it in perspective. This one particular store, am I looking here? This one particular store, there's a question mark about this mall. You've had other retailers, U.S.-based retailers like Coach, Hugo Boss, have gotten out of there. So I'm not sure how much to read into this one particular mall, but let's dial the lens back and talk about the big picture in China. China is a huge market for Apple, and they have seen sales declining there for a whole host of reasons. Most recently, you have to look at the domestic economy in China. There are deflationary pressures. There are questions about how much the tariffs are going to affect that economy. Remember, exports are a huge part of China's global economy. So demand there, how big is demand for products like Apple's iPhone? That's what Apple needs to take into consideration. We're going to be hearing from them in the next couple of days to see how things are going in China. And don't forget, there's a lot of competition domestically in China from names like Huawei and Oppo and Vivo. We talked about them before, but the competition there is real, and people are looking for alternatives to Apple because of all these questions about U.S.-China relations and whether and how much pressure the government is putting on domestic markets to focus on China names and not Apple.
That sets us up really well for earnings, where I think analyst consensus is that they will swing back to revenue growth on a year-on-year basis in Greater China. So we wait for that. The headline this morning is from the Wall Street Journal, and that JP Morgan, in a pack of many, is now the front runner to take over the credit card business. Interesting in the sense that services for Apple is important, but what do we need to know?
Well, remember that this is an important relationship for the banks. Goldman tried it with Apple. It fizzled. There are questions about Goldman's consumer strategy and whether that was the right mix for them. It's a big deal for JP Morgan, gives them an opportunity to push financial services products to a whole new legions of Apple customers. Big deal for them.
Bloomberg Senior Executive Editor for Tech, Tom Giles, here in San Francisco. Thank you very much. Let's stick with that China story. US and Chinese officials are in their second day of trade talks in Stockholm, this to extend their tariff truce beyond an initial 90-day period. Let's get over to Stockholm, where Bloomberg's Oliver Crook is standing by. Oliver, what's the latest?
Yeah, that's right, Ed. We're just in the briefing room here. We're expecting Treasury Secretary Scott Bessent at any moment now in the next couple of minutes. Jameson Greer, who have been locked in discussions with their Chinese counterparts for the last 2 days with the Vice Premier of China. 5 hours yesterday, about 6 hours so far today in terms of the trade negotiations. And the ambition, as you say, Ed, is to extend that trade truce that currently stands between the United States and China. Those tariffs from the U.S. have dropped down to 30%. 20% of those are fentanyl related, 10% of those sort of baseline tariffs. And that's down from the the 125% level we reached at the sort of fevered pitch of the trade war between the two sides. That is set to expire on August the 12th, and that is what they're sort of locked in the discussions to try to extend over another 90 days. There are a panoply of other issues, Ed, as you cover every single day that they have to discuss. The question will be, did they make progress on any of those things? Is there enough progress to give a kind of timeline on when a comprehensive framework could potentially be happening with the Chinese? Could there be something of a timeline on the meeting between Xi Jinping and Trump? These are going to be all of the questions that are going to have for Treasury Secretary Scott Bessent, and probably a few other questions on other issues of trade. The deal with the EU, there's still some open questions about steel tariffs, about pharmaceutical tariffs, so a great many questions to put to the Treasury Secretary when he comes out here in the next few minutes.
There certainly is. Oliver, just going back to our sweet spot of tech, there has been a lot been made of rare earth metals, whether or not they've actually been able to get more swiftly from China into the United States. And of course, there was that offering, that olive branch of H20s going back from NVIDIA.
Yeah, that's right. And that's really kind of the only place you've seen a great deal of olive branches extended from the U.S. and from China to one another. And we should say these are not just sort of acts of goodwill. These are two sectors in which each side is dependent on the other, whether it's the Chinese who have a stranglehold on those rare earth metals, on those magnets, or whether it's the United States that has a stranglehold on those advanced AI chips. And they've made those concessions, but not necessarily out of the goodness of their heart. There is going to be a question about whether or not those deliveries, those rare earth metals have been flowing. I'm sure that will be one of the questions to Treasury Secretary Scott Bessent. So we will get a little bit more detail on that, Caroline, in the next couple of minutes. So stay tuned, and we'll hear from the Treasury Secretary quite soon.
We'll be coming back to you, Oliver Crook. Thank you from Stockholm. Look, let's get you broader context now. Michelle Hyde is with us. She is the CEO of the Kroc Institute for Tech Diplomacy at Purdue, served as Assistant Secretary of State for Global Public Affairs under the first Trump administration. That was 2018 to 2020. And Michelle, the context now is one of which US and China are setting themselves up for this race, whether it be in AI, whether it be in manufacturing, whether it be in energy. Which is the most important outcome, do you think, in terms of where we take trade going forward?
The most important outcome is going to be American security, prosperity, and leadership. And that's what all of these trade negotiations are about. They're a means to that end. China has built a massive manufacturing economy. The United States has built a massive consumer economy. So they make stuff, and we consume it, and we buy it. And now being a consumer at that scale is a big vulnerability when your largest supplier is an adversary. And we buy and consume $300 billion more stuff from China than they buy from us. And that matters when it's not just toys at Walmart and it's not just home appliances. We are consuming things and dependent on them for things that are really important to our national security. As you had just mentioned, rare earth magnets, it's batteries, it's pharmaceutical ingredients, it's the ability to make ships across the world that have a commercial and a defense implication. So rebalancing our trade relationship is key to making sure that we are re-incentivizing our ability and making it more attractive to buy and to build these things at home than to rely on China to do those things.
It's interesting. We, of course, had MP Materials with an announcement that they, as one of the only rare earth metal miners here in the United States, are going to be supplying Apple in some way. But are there enough incentives for what is ultimately a very dirty process? Do we want to bring that home, Michelle, more broadly?
Well, China is either going to do it in a very dirty process because we have seen that the Chinese Communist Party does not have a lot of regard for the environment, or we can incentivize American companies to do it here in a much cleaner and more efficient and effective way. And so I think having America lead in these things, rare earth processing and other critical minerals, is going to be really important. We'll do it much cleaner, more effectively, safely, and trustworthy than the Chinese Communist Party.
Michelle, good morning. It's Ed in San Francisco. I don't want to go broad. That meeting that's happening right now in Stockholm between Chinese trade officials and American trade officials, who is currently on top in this negotiation?
Well, I think what we've seen is that everything is on the table, and the United States has a lot of leverage. As you said, they want a lot of things from the United States, including our chips. And including our consumer economy, because they are largely export based. And so we matter to them as much as they matter to us. And so I think everything's on the table. And ultimately here, the goal is to walk out with a better deal for the United States so that we are more prosperous, more free, more secure, and we can incentivize building the sectors here that are going to be important to American leadership. The president last week just talked about our big AI action plan and wanting the world to run on American tech. And so we need to incentivize the industries that are going to make that possible.
And one of the pillars of that plan is for America to export technology to the world. How important an export market is China for the American technology stack?
Well, the jury is still out on whether or not China is going to be an economy that wants the American technology stack. If you listen to what Xi Jinping has said, he wants an independent, controllable AI hardware and software foundational system. That means a Chinese tech stack. And so we'll see whether or not Xi Jinping and the Chinese economy wants American tech. It's all the more reason that deals with our allies, like the EU that just happened, like Japan that just happened, matter. Because if you look at the US and our top 10 democratic allies, the EU included, that's like 60 to 70% of global GDP. What a great place to start for us to deploy American technology as the backbone of the global economy in the free world and then start to work out from there.
Michelle, it's almost the one area of bipartisanship has been a hawkish nature towards China. But I think about a potential ban on TikTok, currently not happening. When we think about a potential meeting between Trump and Xi Jinping, some China hawks, some of the most ardent in the current administration, feel frustrated that actually President Trump is giving away too much for a deal. What do you make of it?
Well, I think the big picture is all of these things are chips in the bargaining tools. They're all on the table and up for negotiation so we can ultimately get to a deal that does make us more secure and more prosperous. And so we've seen back and forth on TikTok. We know that the H20 chips from NVIDIA were under export controls in April, and then in July, there were assurances that those licenses would be granted to export them. But all of these things are in flux, and it's part of the high stakes negotiations that are taking place. Ultimately, though, we want to get to a place where we are incentivizing American leadership and security first.
And that takes regulation here at home as well. The AI Action Plan meant to foster growth, particularly when it comes to the underlying large language models and indeed the infrastructure. What's interesting is there is this game of cat and mouse in China, yet more and more sophisticated models, open ones, coming to the fore. How do you measure how far China is in the generative AI race?
Well, I think it's how many countries and partners across the world are adopting Chinese tech versus American tech. And our goal is to have more countries and more companies adopting American tech, and in some cases allied tech if we're not the category leader, so that the tech stack across the world is trusted. And so having a scorecard where we track how many companies and countries are adopting U.S. and allied technology versus Chinese technology is really important. And I think as the president laid out in his AI action plan, what the administration is going to start to do is put together exportable AI packages to start to facilitate that more effectively.
Michelle Guider of the Kroc Institute of Tech Diplomacy at Purdue, thank you very much. Now, coming up, Spotify shares drop as the music streaming company disappoints investors with a surprise second quarter loss. We'll have the details next. This is Bloomberg Tech.
Spotify shares having their worst day in 2 years as the company reported a loss in the second quarter. Let's get more on Spotify's earnings with Bloomberg's Ashley Carmen. This all seems to be about employee pay in some ways and taxes upon that.
Yeah, in some ways, Spotify is a victim of its own success. They've basically said that because they've been doing so well in the stock market, they've had to pay out a lot more than they anticipated to employees for payroll taxes and whatnot. And so that ended up in a loss in earnings per share.
There's a lot of earnings mechanics and financial wizardry around this kind of stuff. Is there a kind of core Spotify story, Ashley, of how streaming audio is going for them and maybe a little bit about their video strategy as well?
Yeah, so Spotify keeps adding subscribers, users, they keep growing every single quarter. It's pretty remarkable. But what's sort of been a challenge for them is figuring out what their next verticals are and seeing that through successfully. So they've really made a push for advertising. That hasn't really panned out. They said now they are going to be kind of rethinking that approach with advertising. Their head of advertising actually stepped down yesterday. He's taking a job at DoorDash. So they sort of suggested that this is going to be a direction that they're going to change course. And then they're making a very concentrated push into video. And on today's earnings call, they said, one of their co-presidents said that this is, a very exciting opportunity, but it's not a necessary opportunity. So I think they're still kind of figuring out where they want to move next.
It's interesting that the weak dollar, of course, plays into all of this, and the third quarter forecast not looking that pretty either. ultimately, they are building more and more users. As they say, it's sort of growing like a weed. So that's got to be a positive momentum story for many in the longer term.
Yeah, I think that that's how they're trying to position this, is that in the long term, they seem very bullish, they're excited, they feel like they've had a really great product. It's just these short-term issues that they're kind of dealing with, and investors will see how they're feeling about it.
The stock's down almost 11%, which intraday is the biggest drop since early April. But if it closed there, it would be the biggest drop since June of 2023. So it's a strong reaction. I'm going to ask you something I ask you every single quarter, because this is how I listen to podcasts. How is Spotify doing in podcasts?
They've really pivoted into video podcasts, and they've been trying to recruit more video creators to the platform. So they really have not focused on these audio podcasts anymore. I've reported quite a bit on how this initiative is going for them. They're still missing quite a few of the largest podcasters on that service for video, but they're still pushing, they're still trying.
Where is the audience for them? Or where's the growth story, at least?
Seems like it's developing markets,
yeah.
But then also just trying to get people to spend more time on the platform, watch these videos, which they compensate based on consumption rather than ads. They're really trying to get people to spend more time through audiobooks and maybe up-level them to different tiers of subscriptions. So I think that's where they're eyeing some possible growth.
Bloomberg's Ashley Carman on the streaming and Spotify beat. Thank you very much. We have another earnings story in PayPal. Look at the shares of the company, down significantly, on track for their biggest drop in almost 6 months. In part, it's just the basics that they're seeing slowing growth in payment volumes. But what happened in the morning session was that the CEO on the call was talking about US retail spending and sort of softening economic consumer data, that kind of thing. But he was basically saying that they see a slight deceleration. And that's kind of worried people a little bit. It's going to be interesting later in the hour, Caro, when we have SoFi, because it's somewhat analogous, right, that we might get a similar or maybe different read on the strength of the consumer through the fintech lens.
Well, from a share performance, there's a very different story for SoFi, which is up a whopping 13% right now. That interview to come, but right here, right now, coming up, we've got OpenAI-backed startup Ambience Healthcare. It's reaching a $1 billion valuation. We speak with the co-founder, Nikhil Baduma. That's next. This is Bloomberg Tech.
OpenAI-backed startup Ambience Healthcare has announced it's raised $243 million in a new funding round, valuing the administrative AI company at more than $1 billion. For more, Nikhil Baduma, Ambience Healthcare co-founder and chief scientist, joins us. It's really interesting. You know, I actually go back to maybe even 3 years, and this is where a lot of people said the promise in the near term was AI and healthcare. You know, the administrative task. But the round is big. I mean, what do you need $243 million to do?
Yeah, I think this round, $243 million, values the company at $1.25 billion. Now, that round is led by Oak, HCFT, and Andreessen Horowitz, and with participation from OpenAI. I think it's a testament to this platform that we've built for health systems, which liberates clinicians from the administrative burden and enables them to focus on their patient. And a big part of it is we've built this sort of best-in-class platform, which in practice, what it does is before the patient walks into the room, the system actually summarizes all the context for the clinician so they know what's going on with that particular patient. In the visit, it's listening in the background. It's generating the documentation automatically for the clinician on behalf of them, right, as well as a summary for the patient and their families. And then afterwards, it's automating all the downstream sort of revenue cycle, coding and billing, prior authorization workflows, which is how health systems get paid. I think it's allowing us to essentially work with many more institutions. We work with some of the largest healthcare organizations, academic medical centers in the country, Cleveland Clinic, UCSF, Houston Methodist. I think this round is a testament to that
Nikhil,
work.
What's the company's core competence? You know, I understand the platform, but what is it that you're good at that's allowed you to build the platform?
I think a big part of it is we've built an incredibly deep working relationship with OpenAI and other foundation model makers to build the most capable foundation models for healthcare and medicine. And we've taken that and packaged that into a series of workflows to help clinicians. So I'll give you one example. We work with Cleveland Clinic, one of the most subspecialized academic institutions in the country. They have 100+ different specialty and subspecialty areas. And you can imagine every single one of those specialists practices different medicine. They have different workflows. There's different administrative rules. And so what we've been able to do is create a platform that services the needs of every single one of those specialists. Over 80% of clinicians at Cleveland Clinic use the technology in clinic every single day for over 70% of those visits. And that's more than 2 to 3 times some of the other alternatives on the market.
Nikhil, go to that relationship, that working relationship that you want to invest in further with OpenAI. What makes your business defensible versus OpenAI just sort of building it themselves?
I think a big part of it is, as you think about sort of the gap between general purpose reasoning models and models that are actually clinical grade and compliance grade, there's a massive gap between models that truly understand the medicine that's happening in every single visit. We talked about Cleveland Clinic and other academic medical centers, just the level of depth in clinical reasoning that's happening across 100+ different specialties, and how that's different from primary care to if you have to go see an oncologist to even an oncological subspecialist who might specialize in a particular type of cancer. And it's bridging that gap in sort of the understanding and reasoning capabilities of these models that ultimately allows us to build software that really solves the problem for clinicians on the front lines.
We are currently, as we speak, just also seeing live pictures of President Trump, who is currently in Scotland. He's opened, of course, a new golf course, but he's also been negotiating with the EU, continues to be discussing relationships with the UK going forward. We're going to be diving into that as and when necessary for you. But let's just return to you, Nikhil, as we hear, of course, what President Trump has been doing. I wanted to go to the regulatory perspective here for your business at Ambience, because I am thinking immediately about healthcare requirements when it comes to privacy. How have you made sure that that's front and center when you're relying on so many different users who, well, each hospital has a different rule case, I'm sure?
It's a great question. I think the idea of how do we build AI that's safe, how do we do it responsibly, how do we roll it out in a way that's effective. We're lucky to work with some of the premier academic institutions in the country, and that's allowed us to build infrastructure not only to create and train AI in a safe and private way, but also the governance processes to roll it out responsibly. But I think the opportunity getting this right is actually massive. You think about the 10,000 seniors aging into Medicare every single day, the fact that in every sort of virtually every category of our healthcare workforce, we're projecting a shortage of 100,000+ people over the next 5 to 10 years. And we, as a country, spend $1 trillion on administrative waste. The opportunity to leverage AI to sort of help rehaul how the system works and have better tools for our clinicians and actually take better care of our patients is pretty exciting.
Nikhil Baduma of Ambience Healthcare, we thank you as we see live pictures in Aberdeen of President Trump surrounded by family, as of course he has been unveiling golf courses, been meeting and doing bilaterals with the UK and indeed the EU-US trade relationship. But coming up, Microsoft and OpenAI may be close to changing the terms of their own partnership. That's next. This is Bloomberg Tech.
So best laid plans as I welcome you back to Bloomberg Tech. I was going to tell you that semiconductors were really outperforming, and then when we went to commercial break, actually most major indices, particularly tech-focused ones, kind of fell away into negative territory. There was outperformance in chips, but no longer the case. However, AMD is really interesting. It got another upgrade today from Bank of America, raising the price target to $200 from $175. And I've been tracking through the month of July loads of sell-side names really boosting price targets on AMD, very bullish. But the stock's performance in that period, in the last month and the last quarter, actually outpacing the analysts' ability to catch up with it. A lot of hope that under the AI action plan and some of those deals we got from the Gulf, that AMD, Caro, is going to catch up a little bit with NVIDIA, which we always say has a technical monopoly in the AI accelerator market.
And you were speaking with Lisa Su just last week after that AI action plan was announced. But let's just shift gears into the other area of AI and the relationship between Microsoft and OpenAI, because apparently they're in advanced negotiations that could change that relationship and actually help inaugurate the AI age. The ongoing talks would give Microsoft access to OpenAI's tech even after the ChatGPT maker has reached its goal of building artificial general intelligence. For more on what is going on, let's bring in Bloomberg's Matt Day. Look, this is an age-old relationship. It was what bore, really, ChatGPT to the fold was the financial backing of OpenAI. But the deal was always that they would have limited access to tech if OpenAI did reach AGI. How is this going to change, Matt?
That's right. So Microsoft, as a condition of all the investment they've poured into OpenAI, they have access to their technology. They can bake it into their products. They're worried for some time about a potential cliff. Should OpenAI say, "Hey, we've built an artificially general intelligence system," Microsoft would lose access to the tech. So what we're hearing recently is that Microsoft is getting more comfortable that the terms they're talking about now mean that cliff might not occur. There might be a way that they can continue to have access to some of OpenAI's technology. Should they hit that milestone.
Matt, we've heard that talks are progressing, that they're positive, but they're still ongoing. We heard from sources that in Sun Valley, Sam Altman actually met with Satya Nadella to talk about the issue. The part of it that is on the OpenAI side of this is that they want to change that corporate structure. What do we know about how these negotiations are moving toward that?
Well, so we know that, first of all, Microsoft is the biggest holdout to that renegotiation of OpenAI's structure. We know that OpenAI wants to alter its corporate charter. They want more flexibility. They want the ability to raise a whole lot more money, and that's really what's kind of ticking the clock here, particularly a bunch of cash from SoftBank. The big investor has the authority to dial down some of that investment if OpenAI doesn't complete the restructure before the end of the year. So it's just created this little bit of ticking clock in the background, putting pressure on both sides to come up with a deal.
And also revenue share, right, Matt? It feels as though OpenAI is realizing, well, how much value they're adding and wants a little bit more of it.
That's right. I mean, if you wind back the clock to 2019 when Microsoft first put cash into OpenAI, Microsoft got a really good deal on kind of a flyer that this AI lab was going to be a big deal. Roll the clock forward. Turns out they're an enormous deal, and OpenAI wants a bit more of that pie for sure.
Bloomberg's Matt Day reporting with the rest of the AI and infrastructure team. Really appreciate it. Thank you very much. We're going to stick with Microsoft, which reports earnings tomorrow. Kash Rangan, Global Investment Research Managing Director at Goldman Sachs, joins us. He covers the software sector, has a buy rating and a $550 price target for Microsoft. TV time, Kash. But you heard the reporting there. Mm-hmm. When you are covering Microsoft, one assumes you have to model in this relationship with OpenAI, both the financial exposure, but the technology exposure as well. What did you hear then, and what do you make of it?
So first of all, congratulations on breaking that news story. So that's incremental development, and we actually published our note later yesterday, and we didn't cover the detailed reporting that you guys did. So that certainly is a wrinkle, but it does not change the overall thesis. Our view has been that the partnership has more legs to it than commonly believed in the media and in the Wall Street community. There's a lot more to be gained on either side of the fence, be it access to technology from Microsoft's perspective or access to distribution and a world-class customer base that Microsoft brings, and the ability to certainly not to overemphasize the very common thing, to train models and run on world-class infrastructure. So I think if this were to progress to its ultimate fruition, that if the deal were to be signed, it would take away a hurdle, at least in investors' perspective, as to what is the time duration that you can bank in your model and what is the longevity of this partnership, because the AI revenues have come out of nowhere seemingly and have scaled and helped Microsoft's Azure business propel itself to a north of 30% growth rate, which we thought was unthinkable 2 years ago. So both parties have so much to gain from this, and I think it's incrementally.
Let me ask it this way. What has the biggest net benefit to Microsoft been from the relationship with OpenAI?
Many things. First of all, that they are tech forward, and you could argue that in the cloud computing cycle that they were not exactly the first ones out of the gate, but in this AI cycle, they're the first ones out of the gate. And there's so much of a cachet and boasting right that you have, especially with CEO Satya Nadella, who is a rank insider of the company, who's been there for a long time, being able to pivot the company at the right time. That's of enormous strategic importance, right? From a financial perspective, what it has allowed the company to do is, although it has required a lot of capital build-out of a scale that the world has never seen so far in the technology world, and maybe in broader industry as well, it has allowed the Azure business to grow at scale. So depending upon whose numbers you look at, we're roughly close to an $80 billion run rate for the Azure business, and AI has helped keep that growth rate steadily in the 30+% range. And if we get an inflection point with respect to AI moving up from at Goldman Sachs, we have this thing that AI is stuck at the infrastructure layer. For every computing cycle, you need to move to the platform and applications layer. When you make the progression, you see monumental shifts that are happening in the market. So that's all to Microsoft's benefit.
The $80 billion run rate for Azure comes in tandem, Kash, with a more than $80 billion need to spend on capital expenditure.
Yep.
Is that
Yep.
currently totally vindicated in your mind's eye? And will we see it increase?
It's a dollar for dollar, right? So a dollar of CapEx gives you a dollar of Azure revenues, roughly give or take. And within that, there's a slightly more inefficient conversion of the dollar of CapEx into AI revenue and slightly more efficient conversion. So we think that it is the right trade-off at this point in time. And the good news of your Microsoft is that you're running a very diversified business, that all the CapEx is not extremely punitive to your free cash flows. I mean, you could run a model where you're not generating any free cash flow at all. But that's not Microsoft's thing. So they do generate a pretty meaningful, significant free cash flow margin because of the health of the overall business. You've got to look at Microsoft not just in the context of Azure, but there is a broader Microsoft Cloud business, which has the M365, and then you have the server on-premises business, and a couple of other businesses that are equally significant in terms of revenue scope and significant drivers of profitability. So they've got the ability to generate the cash to be able to fund this CapEx. That's a very important consideration. So as long as the returns keep coming and you're able to generate a dollar of revenue for every dollar of CapEx, as long as that algorithm, broadly speaking, holds, I think it's the right trade-off for the company.
There have been concerns, though, surrounding Microsoft, whether or not it's just how great the product is to use when you're sat within its ecosystem, but also the cyber issues that we've seen running front and center this month. Kash, how much do you expect Satya to really talk to those issues?
Yeah, I believe that there is a bit of a lag between the actual ChatGPT technology, that is OpenAI, broadly speaking technology, and how much of that gets incorporated in the Microsoft Office Copilot. And I believe that that lag is likely to reduce over a period of time. And we're also implementing consumer-grade technology in the enterprise. I mean, that is a completely different beast. So I'm not surprised to hear what you've heard with respect to where the product is relative to enterprise expectations. And I would argue that the product is, I use it personally at Goldman, and it's come a long way since about 6 months, 9 months ago, and it's likely to go a long way in the future. That version of Copilot that we use today is going to go through significant enhancements.
Right.
The ability to customize it, tailor it to your workflows, all that's going to get significantly better. So the buzz is going to get better.
One thing I've always wanted to ask you, Kash, is present day, middle of 2025, Microsoft is the world's second most valuable company, right? And if I think back to when I arrived in Silicon Valley in 2018, but even 2 years ago, did you see that coming, where Microsoft would vie with NVIDIA to be the most valuable company in the world based on the direction it was headed, pre-OpenAI and all of that?
So when I launched coverage at Goldman in 2021, we had a big price target on Microsoft, and the pushback that we got was, you're implying that the market cap can grow by another $500 billion to it. It's already a multi-trillion-dollar market. Or what was it? I think it was a couple of trillion.
Yeah.
And I think what it comes down to is if you unlock a big tech cycle, the dollars at stake in every tech cycle are larger and larger. And if you are leading this cycle as opposed to being a fast follower, who is to say what the new market? Nobody envisioned this kind of playing out the way it did. So, and we're still early in AI. So if you listen to the economists, they're talking about how the labor market could be incorporated by way of AI. If that were to happen, you got a lot more value creation along the way. So I'm pleasantly surprised by how quickly it has happened. But I was just remarking earlier that Microsoft stock has actually performed in line with the NASDAQ finally since the launch of ChatGPT. For a while, it was lagging. I kept telling myself, this is the company that facilitated the birth of this AI revolution along with NVIDIA and OpenAI, and their stock is lagging. It doesn't make any sense. Right now, finally, we're just about even. So feel vindication.
Kash Rangan, Managing Director of Global Investment Research at Goldman Sachs. Great to have you here on Bloomberg Tech. Thank you very much. Karo, some news.
Yeah, it's time for Talking Tech now. And first up, DoorDash has hired Spotify's global head of advertising. Lee Brown will join the food delivery company as Chief Revenue Officer starting in late August. Now, Brown previously led Spotify's $2 billion ad business across 90 international markets and is set to oversee DoorDash's revenue in the US, Canada, Australia, and New Zealand. Plus, Waymo is set to launch its robo-taxi service in Dallas next year in a partnership with rental car company Avis. Now, Waymo says Avis will serve as a fleet partner, providing infrastructure, maintenance, car management operations. The Dallas deal marks a multi-year partnership that Waymo and Avis plan to expand into more cities over time. And venture debt firm Tacora has raised $685 million with the backings from the likes of Peter Thiel and Mark Andreessen. Now, according to CEO Kerry Finley, the money will be used to make loans to about $20 to $30 million to startups. Now, the latest investment brings the firm's assets under management to about $1.4 billion, Ed.
Okay, coming up, SoFi CEO Anthony Noto joins us to discuss the company's second quarter results, an upbeat forecast, and my goodness, the shares are really taking off this Tuesday. Stay with us. This is Bloomberg Tech. Shares of SoFi climbing after the company reported second quarter revenue 72% year-over-year jump in fee-based revenues. Let's discuss with the man in charge, SoFi CEO Anthony Noto. You know, the SoFi story, Anthony, has become kind of simple. You've kind of invested in fee-based business lines, many of them. They've been consistent, but now what the market seems to be seeing is that flowing through to the bottom line as well. Would you just explain how that went in the quarter?
Sure. We've made a conscious effort to diversify our business into these capital light, less credit risk fee revenue streams, one of which is our loan platform business, where people pay us to use our originations platform, which includes our underwriting capabilities, our marketing capabilities, and our servicing capabilities to produce loans for them for a fee that they pay us. We also generate fees in our SoFi Money account business through interchange, as well as our brokerage business, and then, of course, our credit card businesses. And so as we've diversified the products that we offer, the revenue streams have also diversified, where about 44% of our revenue now comes from these fees that are generated without use of capital and without credit risk. And so that de-risks the balance sheet quite a bit. So our ability to grow the overall business 44% with a 29% operating margin is reflective of that diversification and less risky revenue that's more visible as well.
Anthony, you just talked about de-risking. Elsewhere in the earnings domain, PayPal was asked about the strength of the US consumer, and comments from that company were somewhat negative, that they see some sort of cracks in the strength of the consumer. From those that use your platform and your various financial offerings, what are you seeing present day?
Yeah, they have a very different strategy and business than us, and a very different target audience. We're appealing to the overachievers in the United States that are looking for ways to be able to save, to achieve, and invest to achieve their long-term ambitions, whatever their American dream may be. So we're helping them spend less than they make and invest the rest. And we're seeing really strong trends for them. We see them lowering their cost of debt by refinancing out of expensive credit card debt that charges 24 to 30% interest into our loans that only charge 12 to 13% interest. We see them moving their money into SoFi Money. We give 3.8% interest on our savings account in SoFi Money if you're a direct deposit customer or a SoFi Plus customer. We offer them investment opportunities that are really attractive. We offer stocks without commissions, fractional shares. We have SoFi ETFs that are award-winning, as well as robo accounts. But we also offer IPOs. In addition to that, private equity, so you can invest in private credit, private real estate, venture capital funds, as well as long-short public hedge funds, and then finally private growth equity capabilities. And so a much more diverse business. Our consumer is very strong. Credit's performing very well, continues to improve. Spending through SoFi Money is also very strong. So we're seeing a consumer that's really trying to lower their costs and spend less than they make and invest the rest, and the flywheel's really working.
Anthony, it's interesting that flywheel comes at the same time as basically the market's got a flywheel of its own, and we're seeing froth in certain sectors. Retail investors really wanted to get in on the latest meme stock, as well as IPO. How are you thinking about generative AI, like helping with the education side of things? I know you're targeting overachievers, but are they diversified enough in their own investments?
Sure, and let me take your question and talk about what I think are two technology super cycles that are unprecedented. We're driving the growth that we are over the last 8 years without the benefit of crypto or blockchain or AI. But I think the combination of blockchain and crypto, as well as AI, are two super cycles that will put a tailwind behind our company and really help us really revolutionize the financial services industry in ways that continue to give people faster ways to send money at lower cost and to do it safer. In addition to being able to invest in this asset class, which does help as it relates to the areas outside the country that may not have exposure to the U.S. dollar and its stability. In addition to being able to invest in that asset, will allow people to borrow against that asset, which will lower their cost of funding. In addition to that, will allow them to be able to pay across borders more easily and quicker. Artificial intelligence is helping us today across our entire business. We're using it in the back office to resolve disputes faster, to file suspicious activity reports, to solve account takeover issues faster. On the consumer side, we're offering something called Cash Coach, which is the ability to look at your cash across all your accounts. So it's really, that's not impacting our results yet. It's on the come, but they're both really exciting super cycles to see the benefits from.
Anthony Noto, CEO of SoFi, thank you very much for joining us. We actually have some breaking news crossing the Bloomberg terminal, and it comes from China's trade envoy, Li Chenggang. He's talking about the progress of talks in Stockholm. He says that the US and China have agreed to extend the trade truce. They have exchanged views on various macroeconomic issues. They agree on the importance of safeguarding Saudi trade, and that the talks have been constructive on major topics. The main headline, I think, right, Caro, is that they have agreed to extend the trade truce, and that the talks between China and US negotiators currently in Stockholm will continue in what Li calls close communication.
We will go out to Stockholm as and when that press conference starts. But coming up for you, Meta set to report earnings after the closing bell. What to expect from the social media giant that's spending big on AI talent? This is Bloomberg Tech. Meta set to report earnings after the closing bell on Wednesday, I believe it is, with investors closely watching its AI investments. For more, Bloomberg's Kurt Wagner joins us. Look, we've got some big M's to think about more broadly, Kurt, and I'm interested as to where we go in terms of the spending that everyone's looking at. It's about talent, it's about CapEx. Will it be raised?
I think that's the speculation, is that especially once you saw what Google did last week, raising their capital expenditure target for the year, I think there's some assumption that Meta might do the same, given the Scale AI deal and all this very expensive hiring they're doing on the AI front. Now, remember, they already raised the range for their CapEx last quarter as well. So there was a different number in January, a different number in April, and now we'll be watching tomorrow to see if there's another new number. But given the spend in AI, I would not be surprised if they go that route.
And yet, we're always reminded every quarter that Meta makes all its money from advertising. And so there's the AI story where ads are better, priced more powerfully, and then there's like, is all this investment going to pay off? What is the street expecting?
Well, I think the good news for them now is that the AI story they're telling today feels more urgent and more timely, I think, than the one they've been telling for the last year or two, which was related to like the metaverse. And so here now they're talking about chatbots, they're talking about LLMs, data centers, like things that people, I think, have a better understanding of what the potential outcome is. The metaverse was always, Ed, you will remember, the main thing that they were sinking all of this money into, and there was no real end in sight to that. Now, I don't think there's an end in sight to AI either, but at least I think they're doing something that a bunch of other companies are doing. It's a little easier, perhaps, to wrap your head around.
Bloomberg's Kurt Wagner, looking forward to Meta after the bell tomorrow. Thank you very much. Caro, that does it for this edition of Bloomberg Tech, but we had some big breaking news in the last few moments.
We did, and it's so important to the tech ecosystem and more broadly the world economy. We're looking at China saying it does indeed agree with the United States to extend that tariff truce. Remember, it was likely to expire in mid-August as to where currently tariffs have been set at about the 30% level. We did see the Nasdaq 100 just tick into the green, Ed, there. We're up 1/10%. The S&P 500, though, is still in the red at the moment, but it has had, 6 straight days of record highs?
Yeah, and so we are going to read the language very carefully. All those experts on wording. China and US talks were candid, says Li Chenggang. Candid. Good thing or bad thing? The markets will tell us in due course, Caro.
And what does it mean for semiconductors? What does it mean for the flow of rare earth metals? Do not forget to check out our podcast. You can find it on the terminal, as well as online on Apple, Spotify, and iHeart. From New York, from San Francisco, this is Bloomberg Tech.